The Wealth Advocates simplify the financial world and show you how today's events could affect your financial health so you feel confident about your financial future.
Good morning, Wealth Advocates Nation. It's great to be back with you, and a happy Veterans Day. And thank you to all those that served. This is a great day. I am not only joined by Scott Grover to my personal left, but the man, the myth, the legend, John Mickelson. We're going to have some good knowledge today. We're going to get some good information. This is very exciting. It's our big presentation. This is our year-end planning. So let's talk a little bit about what happened in the markets this year. Maybe we'll even take a run at it. And let's talk about what should we be doing by the end of the year. So at Wealth Advocates, our secret sauce is this. We try to make sure that your investment plan matches your income plan, which will match your estate plan and your tax plan. That's a big one today. And finally, your risk plan. We want to make sure that that whole holistic and combined approach to wealth management occurs to make you successful and hit your goals. So that's it. What should we talk about today? John, what do you want to talk about?
Well, the two big topics for the day are what's happening in the economy.
Big deal.
And tax planning.
Okay.
Now, the economy, I think what we're looking at is a lot of chaos. And by the way, when we look at those areas that we covered, that's only one of the 5 areas. I think that's an important point to remember, that as we're looking through this, a lot of times we'll hone in on one of the 5. That's kind of what we're doing with the economy right now, how it relates to your tax planning and also to your investment planning. But we'll also talk a little bit more about kind of the tax aspects of it, how that's going to affect what we do, not only between now and the end of the year, but in the next few years. There's going to be some big adjustments and changes we need to consider.
Awesome. All right, well, let's set the stage. Let's talk a little bit about what's going on in the economy, because that's going to impact what's going to go on with your tax strategy. I think we had to get a real run at this. Scott, what happened in 2022?
2022 was I like to call it a consequence year from...
Oh, well said.
Yeah, that is a good
exactly
term.
what it was.
Yeah. We had a little honeymoon phase of all the money being thrown at us after the pandemic. And then 2022 happened, and we started to see inflation. We started to see interest rates go up. It was a combination of a lot of unrest with what's going on in the world. So as time went on, rates started to go up more and more. Mm-hmm. And it kind of hit rock bottom in June. And, historically, that part of the year is okay, the middle of the year. But with the interest rates rising and with all the unrest and everything that happened, the delayed consequences from the pandemic, we saw quite a big
consequence here. That's so well said. So the market, depending on what the market is to you, the S&P drops 19%, the NASDAQ drops 31%. That's more of our tech sectors. What's driving all that? You called it the consequence here, but there's all kinds of things packaged inside that.
Yeah, we got hit with not 1, not 2, not 3, not 4, but 5 different...
Perfect storm.
Yeah, it's a perfect storm. And quite honestly, with how hard we got hit by so many different things, it could have been much, much worse. So the big one, obviously, was the recession fears, interest rate risk, inflation, the government possibly shutting down. There was a lot of fear. And with fear and uncertainty, the markets equity markets do not respond well to fear.
And we had to use that as a undercurrent for all of our conversation today, because there's so much fear mongering going on in there. So we have this massive drop in 2022, and everybody's afraid. What happens in 2023, John?
That was the transition. So if what Scott said was, inflation hit and things got really tough, and there was a lot of money out there, lots of cash out in the market. Then what happened was businesses realized inflation's hit. All my models are wrong. Mm-hmm. They're all off.
Yeah.
My costs are wrong. They're way too low. Now they're high. And my profit margins, they're disappearing because my costs have gone up. So 2023 was the adjustment year. That is where a lot of companies adjusted their pricing. We saw prices go up dramatically. Yeah. That was very evident, more evident in 2023 than 2022, ironically. And so in 2023, after companies retooled, they said, okay, we've repriced everything. Our profit margins are now there. Now we started to see growth again. And so we saw a big run up in the market in the first half of the year until about July. And so then what happened in July, a lot of geopolitical risk, a lot of negative news. And so that kind of drove things down, and yet companies were still profitable. Now, one of the things I think is an interesting study of human behavior is you look at 2022 and 2023. One was a really bad year, 22. 23 was actually good. And I have had, even in the last few weeks, people come in and said, oh my gosh, it's not very good.
Yeah.
It's actually been quite good.
They're mostly surprised.
Depending on where you are.
Well, we've been trained to be so negative over the last 3 years that it's like, well, positive news.
Yeah. And we're in a eclipse environment. What I mean by that is we see a little clip here, a little clip there, and we lose perspective on what's really happening. And so, I mean, that's one of our jobs is to say we've got to look at it in a broader perspective, because whether you looked at 2022 or 2023, you still bought gas, you still paid for your groceries, you still went on vacation once in a while. That is what drives the cycles in the economy, and they will continue. And even in these chaotic environments, it's not like we haven't seen hard, chaotic, difficult environments in the past, and yet the markets still grow. So the important thing is to look for the opportunities, because whenever there's chaos, that is where the opportunities come up all over the place, but it doesn't feel that way.
So are we out of the woods? That's the big question.
I guess that depends on what you think
The woods are?
The woods are, yeah. Are the trees going to get smaller
I
as you
think
walk
there's a
along?
lot of catalysts in the market. We had to explore each of these, and I've put a couple on the board here. We're going to talk about inflation. We had to talk about interest rate changes, recession concerns. That is the out of the woods conversation. And then this little stunt that Hamas pulled in geopolitical risk. How far reaching is all of that? So, John, inflation.
Yeah.
Talk to us about inflation. What's going on?
So if you watch what happens with inflation, and whether you look at it historically or just look at it from an economic standpoint, the reality is what I described is when it hits initially, it's terrible for the markets. And that's what we saw last year. Once we see that companies adjust to it, and incomes are a big part of this. So it's not just the fact that costs have gone up. You've got to look at people have to still be able to pay for what they're buying.
Yep.
And that's what we're seeing right now is one of the strategies of the Fed is they know they put too much money out there in the system. The money supply is too big. They're trying to burn it up. And so what's happening, costs go up and people's savings start to shrink because their incomes can't pay for everything and they start using reserves. So we're starting to see that. Now, in the scope of what it does to the markets, initially, inflation drops the markets. But after that initial burst, usually, and almost always, you start to see a series of good years. So inflation isn't necessarily a bad thing when it comes to the equity markets.
But it does take a little while for everything to catch up, right?
Yeah, oh, absolutely.
So everybody's concern is, how are my kids going to ever afford a house? Well, very good point. I mean, houses are, $500,000 for a starter, $1 million for a modest middle class home.
And to that point, incomes have to justify paying for those houses. Yep. And incomes are not going up as fast as the costs.
And I love your relative concept that you always start your presentations with of think of the first home you purchased and think of the last car you purchased, which was more expensive. Well, a lot of my friends will say, hey, I bought my first home for $66,000 and my truck costs $80,000.
Yeah.
There you go. There's inflation. Somehow you were able to grow into that.
Well, and you can say, have we seen it in the past? Yeah. I mean, everybody remembers their parents talking about the 70s and how interest rates and everything else. And yet somehow all of us bought homes.
Somehow we do it.
Now,
so in the space of inflation, the Fed's response is always just exactly what you said. Let's burn up that money supply. We're going to raise interest rates. Never before have we seen interest rates hockey stick like this, though. In the last 20 months, we've gone from 0% to 5.25%. Now, the good news is in the last couple months and over the course of the year, we've seen a couple breaks. We've seen in October where they said, okay, well, we'll skip this one. But the Fed said, we probably will do another one before the end of 2023. We may do one in 2024. I will say that a lot of analysts are calling their bluff because they're killing the banks.
Yeah.
So there is recourse to raising interest rates too quickly beyond just what it does to the consumer. If you start to rattle the entire financial market, well, maybe we've gone far enough. And that's everybody's hope is maybe we've gone far enough. So we have a gap right now. We have a rest. hopefully we're kind of at the tail end of this, if not done with these interest rate hikes, because it is hurting.
Well, and there's speculation on the next meeting, whether everyone has said they're going to raise rates one more time.
Yep.
Now we're starting to see indications that maybe there's relief, but I think that's a big question mark. Are they going to raise rates before the end of the year?
Yeah.
And, even just talking about it, the markets have already factored in that part of the equation.
Yeah, that's true.
So, if they do raise it, the market kind of already has an idea that may happen.
Yeah. So it wouldn't be a shock. I mean,
I don't think
even
so.
on the last meeting, the shock was when they said, it wasn't that they raised interest rates, it was they said, they're probably going to stay up a lot longer than you think.
So let me ask
that
this,
shocked everybody.
Is it all bad? Is interest rates going up all bad?
No.
No, especially on the fixed side, because we never could earn any money on our safe money.
We had to
We had
wade
nothing.
seniors so far deep into the risk pool
Yeah.
because there was no income on the fixed side. Now, I've got huge portions of my portfolio sitting in a liquid money market account. You give me $1,000, I can earn you 5.25%, and you can have it tomorrow if you want it. It's
Yeah.
100% liquid. Boy, that's real competition with the bond market, with the annuity market, with all these other high risk things. There's low risk ways to earn a lot of money right now, right?
Yeah. And it used to be a big spread between what equity markets could earn and perform and what the fixed rates. There was a big spread. Now with them up at 5 and 5.25, the spread between risky assets and non-risky assets is not as big as it was.
Now, we're always complaining that the Fed's raised interest rates too much, too fast. Talk to me about relative terms. I mean, we're at 5.25%. Is that the worst we've ever seen?
No.
There
No.
we go.
Yeah.
And then we lose. This is again where perspective is an amazing thing. Because you've talked to people. It's funny because for the last few years, I had a lot of people coming in and saying, I really want to get out of debt. I want to pay off my house. Now I talk to them and they say, well, but it's at 3%. It's at 3.5%.
Free money.
I'm not paying that thing off. It's funny how that changes your perspective.
It does.
But the reverse is true. I mean, we're seeing 6 to 8% on mortgages now, more toward the 8%. And you look historically and you think, well, it's a little on the high side, a little historically, but we've been accustomed to 3% money.
Yeah.
And that's a hard thing to adjust
I don't even know if it's even a little on the high side historically, because I remember buying my first home, little tiny $140,000 house, 8.5%. And I was high-fiving everybody. I got the greatest deal in the world because my college professors were talking about when they got their first mortgage at 19%.
Yeah.
Can you believe that?
I know.
Every 5 years, the debt would double.
Yeah.
How could you pay it off fast enough?
Yeah.
So in reality, this is manageable. We can live inside an 8% mortgage. We've done it a million times before, and guess what? We'll do it again.
Yeah.
So let's talk about interest rates, rising interest rates. What else is that going to impact? Is it going to impact anything else in terms of investing?
Well, I think if you look at the Fed, what they're targeting is they always say they want 2% inflation.
Yes.
And that's the reaction. I mean, it's starting with that number and saying, how do we drive it down to that number? Which maybe they will, maybe they won't. But the inflation number is really the tool they're using as the primary source of saying, how do we drive that down? So if inflation has dropped or it's dropping, that will help us a lot in terms of the interest rates either leveling out or coming down, which who knows when that will be.
I'm excited about what's happening in the bond market. For years, it's been hard to find good tax-free municipal bonds. Now it feels like the inventory is not quite increasing, but there's definitely an appetite for businesses. We're not really interested in corporate bonds, but specifically for cities, states, water districts, things. That's what we love, is that utility-based entity that's a government bond. It's tax-free, and there's more appetite. If the interest rate comes down, then yes, we'll go out for a bond. That means there's more inventory for us to choose from. A tax-free income strategy for my people, that's what my investors want to see. Are we out of the woods? Let's go back to recession. Are we done with recession, Scott?
I don't think we are.
Really?
But I also don't think it's going to be as bad as everyone thinks it's going to be.
Okay.
And here's an example. I was actually talking to a friend about this earlier today. If you were living during World War II and you didn't know the outcome of the war, it probably felt like the end of the world, right? But now that we've had plenty of time to go by, we know how that went, We're all at peace. We know how that ended up. Luckily, the world
What a
didn't.
great Veterans Day strategy.
Yeah.
Thank you.
Yeah, I mean, even
Thank you for driving that home.
You're welcome.
We're big supporters.
I mean, even
of our
Desert Storm. We don't talk about Desert Storm very often,
Nope.
but during the time, Desert Storm was a big deal.
Yeah.
And if you were in the middle of that, you didn't know the outcome. So I kind of feel like we're in the same thing. Yeah, it could go really well, or it could go really bad. But my take on it is we are over exaggerating in our heads a little bit. I like to set the stage that it may not go up because there is always that chance, but I don't think it's going to be as bad if it does go down.
John, your response to that?
I look back at 2022 when we were heading into 2023 and people saying, well, we might be going into a recession. And I kept thinking, we're in one. It's happening
For a
right
long
now.
time.
And I don't care how the government wants to define it. It's a drop. It's a significant drop. And it is a recession.
Yeah, they dangled that carrot in front of everyone's faces for a
And they kept
long
changing
time.
the definition from what it was in the past. So, it depends on what you see as a recession. But the bigger factor is a recession is just kind of a small point in time. I'm more interested in the cycle, meaning a series of 6 or 7 years. And I look at it and think, well, what are the fundamentals in it? I mean, our debt structure is the biggest kind of drag on the whole thing. And everybody's aware of that now. It's funny because like 4 or 5 years ago, the debt was going up dramatically and no one would talk about it. It didn't matter to them. Now it's like the forefront of discussion.
Yeah.
So I think there are definitely challenges and problems, especially on the geopolitical front, and we'll talk about that. Those are more emotional. And what I've seen is there's a lot of emotion everywhere, like hypersensitivity in multiple areas. And what that does is it swings things up and down and up and down. And then the real core numbers come out, and then it equilibrates right back to where it's supposed to be.
And I'm kind of on the opposite end of the corner. I think the recession concerns are overblown. I look at job numbers. I look at how tight the labor market is. You can throw a stick and find a really good job. It's not so bad that your waitress is still making $120,000 a year anymore, but it's got back to the point of, well, we can keep people and we can kind of find people, but it's still tight. You have to run a really good ship because people have options. So the labor market is very, very tight. The economy seems to be expanding in all kinds of different directions. Can you imagine, well, when we were growing up, everybody told you not to get in cars with a stranger, and now we get in cars with strangers all the time in the name of Lyft and Uber, right?
Yeah.
All these new economic developments, especially like in the tech sector, we see Amazon not just delivering books, not just delivering your goods and services in 2 days. Now they're getting down to a one-day model. So look at what tech has done for a broadening economy. It's very exciting, and I don't think there's any room for a recession going forward.
Let me add one more thing to that, and that is there's a lot of discussion around AI and what it's going to do, and there's a lot of fear around AI. Well, I think we've seen this in the past, and what I would say is it's another technological tool that will make us more efficient. I mean, I fully intend that we will use it as a tool within what we do. I don't think it's going to replace a lot of things. I think people still want human interaction.
Yeah.
That's my opinion.
So to your point, I remember my father-in-law telling me, when they came out with color TV and they were broadcasting football games live. One of the biggest worries is like, people aren't going to go to the football games now because they can just watch it from the comfort of their own living room.
Wow.
And, I think people still go to football games.
Yep.
DVD,
Blockbuster and the movie industry. Yep. Nobody's going to go to the theaters anymore. It's the same principle.
Same principle, yeah.
The idea is that we'll still adapt, and that's the number one thing is adapt. We will be changing and shifting, and that will create opportunities.
So let me shift gears and go back to fear-mongering a little bit and talk about geopolitical unrest. A couple of years ago, it was Ukraine and Russia. That was their war. Now it's Hamas and Israel. That's a little closer to home. And China's on the forefront of, will we be able to do business? Now that hurts because they supply everything for us. How's geopolitical risk going to impact our economy?
Yeah, that's a good question, just because I think we're losing sight of the fact that we still live in a global society and we need each other. For example, what you just said about China. We get all of our supplies and things from China. Well, who needs who more? Do they need us more, or do we need them more? And I think there's probably codependency in there, and it goes back to almost like the Cold War. What was the defense? Well, we hope that the Russians love their children. And I think there's a lot of truth in that today. I mean, we still, mutual benefit is still the number one rule. If we can both benefit, that is what creates opportunity for everybody. It is not a zero-sum game where if they lose, we win. That's just not the world we live in.
Right. Okay, let's burn through a couple more of these. The economic and market outlook. I definitely want to continue this theme of fear marketing. Mike, you're going to put this on the slide set, especially this slide. This is slide number 16. This is on the same day, Business Insider, playing both sides of people's fear. On the one hand, the stock market crash. There's a recession that will sink the S&P 500 by 40%. On the exact same day from Business Insider, why the stock market could rally 25% in the next 12 months. So we have a crash, we have growth.
Wait, so they predicted it. They were right.
They got it. They nailed it.
Business
they
Insider.
Nailed it. Good job. What are we saying here, John?
I think the number one thing is, what is the intent? What are they trying to accomplish with what they write? Well, it's a salesy push towards trying to get people motivated. What motivates people? Fear.
Yep. Yeah.
Love, fear, and greed. Those are the big motivators.
It would be go ahead.
I was going to say, just fear, short term, doesn't last. I mean, it scares you in the moment, and you react, and you use your illogical brain, and it often makes mistakes. So, and that's one of the big things is to maintain perspective and, again, sit back and evaluate before you react.
Okay, so in that vision of maintaining perspective, I'm looking at my watch, not because we're out of time, but I needed to remember the date. It's November 10 when we're recording this right now, Veterans Day. We're in smack dab in the middle of the fourth quarter. And perspective, let's talk statistics. There is historically 76% chance the market goes up in the fourth quarter. Now, historically, we come to the table with all of our clients and say from August to October is the most volatile time of the year. Hedge fund managers are making all kinds of ripples as they rebalance portfolios. There's all kinds of change happening. It's often an election period. There's lots going on. In the fourth quarter, you have an earnings report. Our earnings report has been spectacular this year. Most of your tech companies have reported great numbers. And here's a great example. Microsoft and Google report 2 weeks ago on the exact same day within 15 minutes of each other. Microsoft beats earnings. They're duly rewarded. They get a 4% jump in market after hours. They're doing fantastic. Google comes to the table 15 minutes later. They kill their numbers. They beat them by 8%. Their stock drops 12% after hours. Why? They're the same company, right? I don't know. There's a lot of emotions going on at the table right now. A lot of fear mongering, but statistically, the market goes up in the fourth quarter, and by the numbers, the economy is very strong. I think we're headed into a great fourth quarter. The Santa Claus effect, I think, will carry us through the rest of the year. 2024 may be a fantastic year. So what do you guys think? Let's look at it in terms of a longer term perspective. John, you talked about cycles, 6-8 years. Talk to us.
And the clip effect, the click, 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 and you get what's happening today. Now, you can see the graph is showing us that if you give any period of time, we have great growth. The key to that is to not only be in the market and be invested, but be logical in the way you approach the asset management. Because nobody's going to be, this is all showing just stocks. How many people do I know that are 100% stock? Not very many. That is not wise.
They shouldn't be.
They shouldn't be. That's not a logical, safe approach. So the big thing here to kind of gather from this is over time, you need the idea of, let's just say that there might be a few people out there that have a retirement plan and they set their allocation 5 years ago and it's still exactly the same thing today. I'll bet that happens in more cases than not.
Yeah.
Set it and forget it is not a good strategy. You've got to be able to adapt to a very rapidly changing environment. That's kind of where we come in to try to make sure that we're not just leaving it exposed when we should be moving something. So the other thing I'd say is, the other example I shared earlier, we lose perspective. We lose perspective in the short run. And we look at things in a very, our memories really are not that good. I mean, you think, biologically, can you remember what you had for dinner on Wednesday last week? I mean, people don't have that kind of memory. And so we lose sight of a lot of the information and data that has occurred even in just a week ago. And my example is my dad. My dad, when he was alive, he had a little bit of dementia, so his was even more exaggerated. But we could have 5 good days in a row, and then one day it drops, as a reaction to those 5 good days. And immediately he'd call me, John, are we okay? And I'd say, Dad, tell you what, how about if I double what I put in your bank account every month? And he'd say, well, I don't need that. And I'd say, I know, I just want you to know you can do it. Yeah. And so, the important thing is to have someone, and whether it's us or someone else, someone that can give you perspective and really understand. Because if there are legitimate dangers, we do need to make adjustments. That's the flip side of it.
Yeah, and if you're feeling that way, I want to know that you're feeling that way so I can help you recalibrate and see things from a different perspective, like you were saying.
Yeah. And
Timeline matters.
Very often we have people come in, and once they run through, here's where you are, here's your defense, here's your offense, and then they go away feeling, okay, we're fine.
Okay, so let's do a quick wrap up on the market side of this, because we really need to dive into the tax discussion. Yeah. We want people to be cautious. Be cautious. Don't be 100% into the NASDAQ. That is nuts. Inflation's a concern. It's going to be a concern for a little while. The recession, Scott thinks it's a possibility. I don't, but you decide. Long-term investing, though, like John said, those cycles, that's the important thing. Are we in a strong economy? And as John just articulated so well, objectivity. We're here to help you through the objective part of it. You care about your money more than I ever possibly can. That's good for you. I'm good for you as well, because I'll bring an objective, analytical approach to your money. So let's talk about what we should be doing in the end of 2023. We're going to talk about proactive planning. We're going to talk about reactive approach to produce better results. So let's talk tax planning versus tax preparation. Let me just insert right here. Our compliance officer, Sonia, hates it when we talk about tax planning. We're not accountants. We're not moving the numbers from one box to another box. We're here to look at what are some strategies we can implement. So don't hear that I'm a CPA, because I'm not. I'm an MBA. Go ahead, John. What do we need to say about this?
Well, the big thing is a good accountant is worth his weight in gold.
Yep.
And so it really is valuable for us to be able to have someone that acts on a team. And it doesn't mean we have to be with the same guy all the time. Whoever you work with, we can work with. But what I find is accountants are at a big disadvantage, because they get all the information after the fact, after nothing can be done at the past the end of the year. Mm-hmm. So very often, the woulda, coulda, shoulda, they don't even want to bring it up because there's nothing you can do about it. So what we've done, we have a good software system that helps us go through the taxes and say, here's your tax return from last year. Here's what's coming. Have you done this? Have you done this? Have you done this? So we're trying to help complement the accountant, and the accountant can complement us by looking at those things and saying, what do we need to pay attention to between now and the end of the year? And it's very often people don't ever look at that, because it's hard enough to read a 1040.
Yep. Exactly. Yeah, it's very confusing. Okay, so let's lean into this. Scott, give us the tax brackets. Give us the ground rules here.
Okay, so the basics of it, there's 7 different tax brackets. You got the 10, the 12, the 22, 24, 32, 35, and if you're lucky, you're in the 37% tax bracket.
Okay. That's not very lucky. Now, that's just federal, because in Utah, we have state on top of that, so that's state. 5. Mm-hmm. In Idaho, it's 6.1, 6.4. I always lose track of that one. So if you're lucky, you live in Nevada or Washington or Texas, that doesn't have an state income tax. John, what about the standard deductions?
Yeah, so with the last few years, standard deductions have become more important, because the value or the size, they're $13,850 for an individual. Filing jointly, you can do it, double it. And so that allows you to have a substantial amount of money that is not taxed.
So if I'm single, my first $13,850 tax-free.
Correct.
If I'm married, $27,700 tax-free.
Exactly.
The first bit, right?
So now, what's the trade-off? Well, if I have itemized deduction, charitable giving, business expenses, things like that, if I can exceed that number, I'll take the itemized.
So let's talk about bunching. Just to jump right into that. You're headed down that path.
So in some cases, you can say, well, what if I take this year's itemized deductions and next year's itemized deductions and lump them into 1 year?
Yeah.
And then in the other year, I take the itemized or the standard deduction. So it's grouping as much as you can in 1 year and then taking the standard deduction in the other year. And it's a way to say, is there a way for me to get my numbers big enough to exceed the standard
So
deduction?
let's talk about a practical version of that. So donor advised fund, we're taking the asset, the investment, the cash, and we're moving outside the estate, and we're basically creating our own little charity here. So I've got a client, he's selling his business. He's a very charitable guy. He knows he's going to give to charity every few years. And so what he's done, he sold it. He has, to John's point, I just wagged my finger at you. I hate that. I'm sorry. He knows he's going to give to charity, and so he's mapped out, here's how much I'm giving to charity, but I had a huge year. I sold my business this year. I need as many tax deductions as I can. So rather than putting $50,000 toward whatever charity, he's going to put 100, 150, maybe even 200,000. He's going to move it out of his estate into this donor advised fund this year, and then he doesn't legally control it, but he does dictate where it goes and when it goes and how it's invested. And he can give to those charities, all the charities, the Boy Scouts, the Girl Scouts, the church, whomever. He gives it to them during the course of what would have been his normal giving, but he got his tax deduction this year. That's bunching, right?
Yeah, exactly. And the way I describe it in what you just said is you could say, hey, I know I'm going to give away money to charities over the next 10 years. I have this great big tax problem today that won't exist then. Wouldn't it be nice if I could get all those deductions for the next 10 years and put them into this year?
Yep.
That is what a donor advised fund does.
Okay.
So that allows you to, and it sits in an account until you're ready to give it away.
So Scott, more ground rules. Talk to us about capital gains.
Yeah, capital gains are usually triggered from an account that's a non-retirement account where you've purchased an asset, you have a gain on it, you sell the asset, and depending on if you've held it for a year or more, you will get different tax brackets, and that's based off of where your income is for the year. So there's 3 basic tax brackets on that. There's the 0%, 15%, and I won't say you're lucky enough if you're in the 20%, but there's the 20%. That means you're doing well, but you're also helping the government do very well.
Yeah. So again, somebody sold a business last year. I think it was last year. So huge amount of money coming in. They're already bounced from 0% to 15% for capital gains. They're in the 20%. But their income was such that it triggered the surcharge tax. That's a fancy way of saying the Obamacare tax. So now they're at 23.8%. And they're in the state of Utah. So now we got to add another 5% to that. So they jumped from 20% to 28%. And there wasn't much of a strategy there. There's strategies. There's lots of strategies to augment, defer, and delay when we pay taxes. And we ought to talk about those. So, John, here's one softball question. Gain-loss harvesting. What's going on there?
Well, and this is a great example of gain-loss harvesting. Last year, substantial losses. Like bad year. You know, the S&P was down
Would have been a great
almost
year for
20.
Roth conversion. Would have been a great year for offset any gains with losses.
So then you can take a stock that you say a stock or a piece of land or whatever, and you sell it at a loss, meaning that I paid $100 and now it's only worth $75. I got a $25 loss. Now, come into this year, and if we can go a full year, we have to have it for a year, but now I have stocks that have gained money. And now I've got a stock that went from $100 to $125. Now what I can do is sell that stock and make the $25 gain and use last year's $25 loss, and it washes the tax out. That is tax loss harvesting. And we want to do that, and that keeps remember, this is only really a strategy for non-retirement accounts.
Right.
It doesn't work in a retirement account. Roth IRA, 401k, 401a. It's non-qualified, non-retirement accounts. But it can be extremely effective. And we want to be looking at that really right now, end of the year. Should we be harvesting gains against last year's losses?
Exactly.
Now, we do that behind the scenes, whether a lot of clients know it or not.
We do it.
We're trying to make sure that the whole thing is my portfolio tax as low as it can possibly be.
So, Scott, we've talked about charitable funds. We've talked about non-retirement funds. Talk to us about retirement funds. This is an easy one. Everybody should be doing this.
Yeah, everyone should be doing this, depending on where, and you're going to want to know what tax bracket you're in before you go into this. And this goes back to what John was talking about. Let's anticipate what's going to be happening before it comes time to file your taxes. So the Roth IRA contribution limits, if you're under the age of 50, is $6,500 for 2023. If you're over the age of 50, you can put in an additional $1,000. They call that a catch-up. And then we have the 401k elective deferral limit, which is $22,500. Again, if you're over the age of 50, you can do an additional $7,500. That's the catch-up. Helps you get caught up for retirement. So hence the name catch-up contribution.
What if you're a single contractor? You could set up a solo 401k with a profit-sharing plan. If you're over 50 years old, you could get $73,500 into an account you control. You're kicking the can down the road, and you're paying taxes at a later date in lower income. Lots of easy strategies that most people are just not doing. I've got one client, and he's telling me I pay huge amounts, almost 7 digits in taxes, but he's only putting a little bit of money into his retirement account. You're like, well, here's an easy one. This is ground level stuff.
Yep.
So, Scott, you talked a little bit about a Roth IRA. Tell me the difference between a Roth and a traditional.
I mean, basically what it comes down to is, do you want to pay taxes now or do you want to pay taxes later? The Roth is you're paying taxes right now. After you've paid your taxes, you put the money into a Roth IRA. It grows tax-free. There's no deadline by which you need to pull the money out, like in an IRA, traditional IRA. Traditional IRA is you're saying, hey, I'm going to put money in right now. I'm not going to pay taxes on it. When I pull it out at retirement, that's when I'm going to get taxed on it. It grows tax deferred, which is the advantage of it. So rather than having the money go to the government, you have it staying in your pocket, working for you for longer.
Really good idea. So, John, why should everybody be looking at, should I do a Roth conversion right now?
Well, in part, it's saying where will the taxes be most effective. So if you take a Roth and a traditional approach, one is saying pay the tax now, one's saying pay the tax later. If you never had a difference in your tax bracket, at the end of the day, you get exactly the same number. They are tax neutral.
Big if. If you never have a change in your tax bracket.
And you have to assume you know what taxes are going to be in the future.
Right.
That's the hardest part of the whole thing. And this is where we do a lot of, or at least try to do a lot of coordination with accountants, is to say, should we be paying tax now? If we say, hey, my tax rate's 10, 15, 20%, it's probably not going to get lower ever. And I always say your retirement plan is like a house with a mortgage on it. What's the mortgage? Taxes. I want a 15% mortgage, not a 35% mortgage.
Right.
So the key is to decide, have I got enough leeway this year to pay a low tax and say, hey, what if I did another $20,000? Would I still be at a low tax? That's the money I move from the pre-tax bucket to the after-tax, to the Roth.
So my favorite question I get, Scott, is you told me that a Roth contribution is $6,500. If I'm an old man like myself over 50, it's $7,500. What's the limit on a conversion?
There is no limit on a conversion.
There's no limit. Unlimited.
Yeah.
Unlimited.
In a year where you have an unusually low year for income, maybe you have a big investment into a business operation, you're on a service mission. I mean, there's a lot of things that can drive income down temporarily. That is the ideal time to be looking at conversion to Roth. And if you see drops in the market, like we said about last year.
So immediate taxes are one of the conversations. Another conversation is required minimum distributions. Does a Roth require a required minimum distribution?
No.
So a lot of my clients feel like, well, I've got adequate income from Social Security, from a pension, from other sources, rental income, and I don't want to trigger the tax that it caused from a required minimum distribution. At age 73, I have to pull out so much according to the government. They give me a table of how much I need to pull out. I'm spending a lot of my time right now making sure that all my clients get their required minimum distribution, because it is a huge penalty. It's 25% of what you were supposed to take. Mm-hmm. But if you're in Roth money, you don't have that requirement. You don't have to pull money out of your retirement. So, huge deal. John, what about 529s?
Think of 529 like the Roth IRA, but for college. Mm-hmm. So you can set up this account for children, and you put after-tax dollars in, no deduction. People confuse that all the time. But any growth as long as it's used for educational expenses, tuition, books, housing. It's pretty liberal. No taxes.
Great.
Now, the one thing that changed, and this is where a lot of people don't know this, is suppose you have a child that says, I don't need the money, or I'm not going to college, or I got Pell Grants or scholarships and not going to use that money.
Yeah.
It can be either one of a couple of things. One, you can take it out and pay the tax, just normal.
Yeah.
You're no worse off. The second one is you can move the beneficiary to another child, or a grandchild. It can become perpetual. Or 3, you can convert it to a Roth IRA for that child or for someone else. Mm-hmm. So that's the Roth IRA is the part that most people probably didn't pay attention to the changes they made. But that's a real big advantage because it doesn't get stuck in just a college atmosphere. So that's what I have on 5.
Really good. Really good. Let's talk a little bit about the present tax law and wealth transfer. When somebody dies, there's an exemption that occurs. Scott, what's the exemption?
Well, at least until 2025, it's $12.06 million.
Per person.
Per person, yep.
That's a huge amount. 24
It is a
million,
huge amount.
12, whatever.
Yeah.
$24.12 million that up until that point, it's tax-free, right?
Yep.
Now, mind you, this has nothing to do with income tax. This is just me handing money to someone else.
Right.
That's it.
Right. Now the big fear is in the sunset, January 1, 2026,
Yep.
the tax code sunsets. It goes back to what it was in 2018. What happens?
Basically gets cut in half.
Yeah.
Yeah. And, the assets will have appreciated more by then as well.
So single person, the exemption $6 million. What happens to that last
So
million
yeah,
dollars?
once you cross that line,
Yeah.
the government, they come and they say,
They
whoa,
get-
whoa.
A huge amount. How
Pay
much?
up. 45%.
They get nearly half
Yeah.
of everything over that exemption.
Bless their souls.
Well, I'll let you dive into that in the religious podcast, but for today, that's a lot of money.
Yeah. And so the planning opportunities around that, there are quite a few that are speculating on the idea of should I transfer out that larger amount out of my estate or a portion of it out of my estate
Or
now
life insurance
before
to
we
pay
hit
tax, or-
before we hit 2026.
Yeah.
So a lot of people are kind of sitting on their hands and saying, hey, it's an election year next year. What's going to happen to all the tax
Very
rules?
important decision.
We don't know. So a lot of it is wait and see. And some people are saying, hey, act now while it's still there. We will have time between November and then the following year when the sunset happens. So, no, it's actually 2026. So it's
Yeah.
really quick.
It's
So you
coming
watch
up.
around that election. That will be an
That's a
interesting
big
thing.
deal.
That's
That's a
so-
big deal.
Yeah.
So let's wrap up with charitable giving. I talked a little bit about donor advised funds, but there's also charitable giving inside of qualified plans. John, can you hit that?
Yeah, if you're over the age of 70 and a half, you can give away up to $100,000 out of your retirement account to a charity. Now, what that means is if I took that $100,000 and I take it home to me, it's taxable income to me, just like a paycheck. If I give it to a charity, what would have gone to taxes is charitable donation. They don't pay tax. So it's a good strategy, especially for someone at that age, to say, if I'm going to give money, start with the qualified, the from my IRA, and then maybe appreciated stock, stock that's a year or longer, you can give that away. And the same principle applies. I would have paid tax, charity won't.
And it's not just the tax, it's also other elements that base off income, say your Medicare premiums.
Right.
Your Medicare premiums will go up if you pull too much out in a given year.
Yeah.
And do Medicare premiums ever go down? No, they just keep stepping them up. And so you want to be careful about how much money you pull out. All right. Well, let's look ahead to 2023 and the tax sunset as our conversation. So in 2023, there's a whole bunch of things we're really concerned about. Individual income tax rates will change.
Yeah.
The elevated estate tax that Scott just walked us through, a couple having exemption all the way up to $24 million, that gets cut in half. It's down to 12. Salt tax, that's the state and local tax. So that cap of $10,000 goes away. Functionally, that means we in Utah, who have very low taxes, subsidize California, subsidize New York, who have high taxes, because they get to deduct all those state and local taxes. Child care tax credit drops down to $1,000. And finally, the AMT comes back into play. AMT is just a deceptive, evil tax where the accountant has to do your taxes twice.
Yeah.
They do it on buckets. You know, what bracket are you in now? Oh, now we have to go back and add everything in and say, would it be more advantageous for the government if you pay the alternative minimum tax? Yeah. So it's an awful, awful concept. Well, that's about it. Let's just wrap this up. Maybe you know somebody, a friend, family member that's outgrown the do-it-yourself model. Consider adding them to our mailing list. We send out a newsletter every few months on great strategies. The most recent one was our tax planning, tax strategy. It covered a whole bunch of topics. We came in here. And anything else you guys want to say about as we wrap up? Final words.
No, just that we're grateful for the opportunity to serve, and if we can help, please don't hesitate to get a hold of us.
Your success matters to us. We hope that you are successful, you're healthy, you're happy, and we want to help you be a part of that. So thanks so much for tuning in, and until next time, I'm Patrick Jenkins, and we're Wealth Advocates. Thank you.
Thank you for listening to the Wealth Advocates. Join us every month by subscribing on Apple Podcasts, Spotify, or Google Podcasts. You can also look for the Wealth Advocates on Stitcher and YouTube. Want more information about today's topics? Reach out to John or Patrick directly by calling or texting the Wealth Advocates office at 435-754-7888. Learn more about the Wealth Advocates and how they can help you by visiting wealth-advocates.com.